Now we're going to talk about how a T account works. If you'll look in your book on page 14, you'll see the chart of accounts that we used in chapter 1, and we just used columns to record how much money we had or how much money we owed somebody. We just had an account, and then we just kept everything in one column. And the very first column was cash. So I'm going to use the cash account to show you how the T account works. Now you'll remember from the last video that assets have a debit balance. And that means on the left side. And you know that because you're going to memorize the sentence, all elephants drive / little red cars. And the A is on the left side of the sentence. So cash is an asset. It is an asset. It is a resource that we own that's going to help us make money. And so cash, the cash T account, is going to have a normal debit balance. And that means whenever we get cash, that's going to go on the left side. So for just a minute, we're going to look at the transactions that happened in chapter 1, and they're also going to happen. Chapter 2 is going to use the same exact transactions as chapter 1, just so you'll have that familiarity and you'll create the journal entries with that same information. So the very first thing that happens to our cash account is that Chris Clark deposited $25,000 cash into our business account. So at the beginning of the day, the very first day of business, we didn't have any cash, and then Chris went to the bank and he deposited $25,000 worth of cash. And you know to put that on the left side because all increases happen on the left side for cash and all decreases happen on the right side for cash. Then the next day, and let me look at my book to make sure I'm saying it right. The next day, Chris spent $20,000 on land. So that would go on the credit side because cash is now decreased. Now you can look at this one little example to see how a T account works. If cash has a normal balance on the left side, then you're going to look at the money on the left and the money on the right and tell which side is bigger. So after you spend $20,000, you'll see that you're going to balance the left side against the right side and see that you have $5,000 left. And that's how much cash you have left at the end of the day. Now, all accounts will have a T account. And there's actually a book of T accounts called the Ledger. And those are going to be 4-column T accounts. It's going to be a glorified T account. And we'll talk about that at the end of this chapter because the right side is just going to balance it out and keep a running balance. But for now, if you understand how this T account works, then you're going to be good to go with the journal entries. So also, when we spent $20,000, we also got another asset called land. So you would debit that asset for $20,000. So for every account that is affected by a transaction, and every transaction is going to affect at least 2 accounts, you're going to have T accounts for each one of those. Now, the next thing we're going to talk about is a journal entry. And a journal entry is where you're going to record the transactions. We won't use the T accounts in reality until after the journal entries, but to me it helps to see the T account to understand how it all works.